Xin kính chào quý vị khán giả. Hello Viet TV Canada. Welcome to the Wealth Expert Show, the show where we teach you how to make the best use of your money to reach your goals in the most efficient way possible. Consider me your financial GPS. I'm your host and wealth advisor, Mitchell Huang. The past few weeks we have discussed personal finance. This week we will speak about business finance. Whether you're thinking about starting a business or looking to learn more about the tax efficiencies and investing opportunities within the business, this episode is for you. When you first start a business, you do so for many reasons. You want to be your own boss, set your own hours, gain financial independence, or have a great idea no one has come up with yet. The list goes on. One of the most important decisions you will make is how to structure your business. There are three main types of business structures: sole proprietorship, a partnership, and a corporation. A sole proprietorship is the easiest and cheapest way of starting a business. As a sole proprietor, you would be fully responsible for all debts and obligations related to your business, and all profits would be yours alone to keep. All income net of expenses would be taxed at your personal tax bracket. As the sole owner of a business, the creditor can make a claim against your personal and business assets to pay off any debt. This means you have unlimited liability for any debts owing. A partnership is a good business structure if you want to carry on business with a partner and you do not wish to incorporate your business. With a partnership, financial resources are combined and put into the business. You can establish the terms of your business with your partner and protect yourself in case of a disagreement or dissolution by drawing up a specific business agreement. As partners, you would share in the profits of your business according to the terms of your agreement. When establishing a partnership, you should have a partnership agreement drawn up with the assistance of a lawyer to ensure that A, you're protecting your interests, B, you have clearly established the terms of the partnership in regards to issues like profit sharing, dissolving the partnership, and more. Drawbacks of partnerships are that, similar to a sole proprietorship, there are no legal differences between you and your business. So you have unlimited liability. Therefore, if you have any business debts, personal assets would be used to pay off the debt. It's hard to find a suitable partner. Therefore, conflicts between you and your partner may arise. And you are held financially responsible for the business decisions made by your partner. Another type of business structure is incorporation. Incorporation can be done at the federal or provincial level. When you incorporate your business, it is considered to be a legal entity that is separate from the shareholders. As shareholder of a corporation, you will not be responsible for the debts, not be personally responsible for the debts, liabilities, or acts of the corporation. It is always wise to seek legal advice before incorporating. Incorporation has certain advantages. You have limited liability, meaning debts can only be claimed to the extent of your business assets and not your personal assets, thus protecting yourself. The ownership is transferable through the selling of shares in the business. Continuous existence. When you die, your corporation can continue to exist and operate should you choose to do so, as it is a separate legal entity. It is easier to raise capital through the selling of shares, and there's possible tax advantages as taxes may be lower for an incorporated business. You may also qualify for a small business tax exemption on selling your business, meaning that approximately the first $800,000 of capital gains on the sale of your business may be tax-free. Disadvantages are that corporations are more closely regulated. Therefore, they're more expensive to incorporate than a partnership or a sole proprietorship. You'll need to keep extensive corporate records, including shareholders and director meetings, and documentations filed annually for the government. Once again, there may be possible conflict between shareholders and directors. However, Our primary interest is corporations due to their many tax and liability advantages. There are many financial strategies we can use to our advantage. First, let's take a deeper dive into corporations. Most small businesses in Canada are able to take advantage of the small business tax deduction on the first $500,000 of income. That effectively reduces your income tax bracket to approximately 15%. If we compare that to your personal income tax bracket, which can range anywhere between 20% to 52%, this is a huge tax savings. Almost 37% income tax savings between the highest personal tax bracket and the small business tax bracket. The key strength of corporations is that you can control your personal tax bracket by limiting the amount of money you take as an annual salary. Let's say that after all expenses, your business generates $116,000 of income a year. So that's after all expenses and salaries have been paid to yourself and your employees. After the 15% business income tax, you will have $100,000 left in the business. By leaving that money in the business, you can control your personal tax bracket. The tax implications arise when you wish to take the money out of the business and use it personally. There are a few methods of taking the money out. Firstly, as a salary, which raises your personal tax bracket. Secondly, as a dividend, which will be taxed at around 39%. This can be a significant tax advantage if your personal tax bracket is much higher. And lastly, tax-free from the CDA accounts. Oh, did I catch your attention with that? Yes, tax-free. The capital dividends account, which is CDA, is similar to your personal TFSA, which is your tax-free savings account, in that anything you put in comes out tax-free. The primary difference is that there is no yearly maximum limit on how much you can put in, but you are limited in what cash flows are allowed to build your CDA account. The CDA is a nominal account in your business, meaning it is an imaginary account. You can't go to the bank and ask to transfer that $100,000 from your business account to your CDA account. That is an account that your accountant or bookkeeper should be keeping track of on your behalf. The question then becomes, how can you put money into your CDA account? There are several ways, and we'll speak about two of them. Firstly, through capital gains. 50% of your capital gains flows into your CDA account and will come out tax-free. You receive capital gains through the growth of investments, such as mutual funds, ETFs, and stocks. If you invested $100 and that grew to $1,000, then the difference of $900, that is your capital gain. 50% of that, which is $450, will be taxed as a capital gain, while the other 50% or the other $450 will flow into your CDA account and you will be able to withdraw it tax-free. The second way, which is much more efficient, is to invest a portion of that $100,000 into a participating life insurance policy. This tax-efficient structure is the difference between having $2.5 million and $9 million. Next episode, I will show you how a simple restructuring of your investments and assets can drastically change your net worth on death, thus providing much more for your loved ones. We will discuss this more in our next episode. I look forward to all of your email questions. Have a topic you would like me to discuss on the show? Need a financial plan done for you or your family? Or just want some investment advice? Contact me at any time at mitch@wealthexpert.ca. Thank you to all of our viewers and see you next time on Viet TV Canada's Wealth Expert Show. This is Mitchell Huang, your Wealth Expert, signing off until next time. See you then. Bye for now.